Stocks trade soft after a U.S. appeals court stays ban on Trump's tariffs. A stalling of U.S.-China trade talks doesn't help matters. Metals, utilities and retail are big losers, even as industrials manage some gains.
Bajaj Auto drives in a steady Q4 with healthy margins, remains confident of healthy domestic and export growth in FY26. Stock, though, is down 2.5%. Ola Electric's losses climb as sales dive.
Suzlon powers up on reporting a big jump in revenue and profit, guiding for 60% growth in FY26. But Mazagon Dock ends the year on a weak note as muted revenue growth and a spike in costs hurts profit.
The early arrival of monsoon may be net positive for the Kharif crop, while data shows that above-average quantum of rains usually results in higher output. Ramesh Chand, Niti Aayog member, tells CNBC TV18, adds that FY25 agri growth may be 4%, and this year can be as robust.
The Finance Ministry has advised RBI to ensure that small borrowers with gold loans of under 2 lakh rupees not affected by the proposed norms. The exclusion of such loans will benefit gold loan NBFCs.
Hello and welcome to Halftime Report. We're coming to you live from the CNBC TV18 Motilal Oswal studio. I'm Reema Tendulkar and with me is Mangalam Malu. Mangalam, a quiet Friday, right? Almost seems like it's waiting for the weekend.
It is waiting for the weekend. If you look at yesterday, the last hour spike that we saw on account of expiry may have normalized right now. The good part, however, is that on day one of the series, the markets moved off lows, and that becomes an important reference point to watch out for every time you start a new series. Though June actually is a bit of a bridge month, if you've noticed, X of any sort of, events, like last June had the interim budget, the first budget of the new government. June has been 2 to 3% sort of moves on either side because it's post-May, post the earning season rush, etc. And then before the next earning season begins, June is the bridge month.
That's in July. That's like just a month away now.
So which is why the market's just biding time. The big cues this time around would probably be the RBI policy meet and all that takes place on,
Today we've got the GDP print.
Yes.
So that will be tracked very closely. And globally, from a US point of view, we've got the weekly jobless claims, the PCE, the core inflation data that the Fed tracks very closely. But it's good to see the mid and small caps outperforming to some extent. I think that mid-cap chart will show you there has been a recovery from the lows. And this week, while the Nifty and the Sensex are down close to about 0.4%, the mid-cap index is up a little more than 1%, 1.3% week-to-date gains, while the small-cap index has a 1.8% week-to-date gain. So it's good to see that outperformance.
It's good to see that. And one of those stocks right now is Muthoot Finance. It's an up move nearly 7%. Manappuram Finance also over the last half an hour or so has seen a big spike. So just pull up the intraday chart of Manappuram Finance. You'll see that the stock has made a recovery from the lows, though not in the quantum of Muthoot Finance. And that's largely because the Finance Ministry has told the RBI to ensure interest of small gold loan borrowers are not impacted by the new draft guidelines. Remember, these stocks had taken a bit of a knock once those draft guidelines had come in. Sapna now joins in with more details on what has transpired out there. And is that, in turn, causing this relief rally on these names? Sapna.
Hi, yes. So this matter has been under discussion, as you can see from the statement of the Finance Ministry. The decision has been taken to forward this feedback or rather this pushback right at the finance minister's level. The discussions have happened at her level. And post that, this feedback has gone to the RBI. So I think on two accounts, the government is very clear that A, the interest of the small gold loan borrowers should not be adversely impacted. Here they have also suggested that, maybe up to a ticket size of around 2 lakh rupees. I mean, such borrowers should be actually excluded from any kind of directions that RBI comes out in the future. And second, more time will be needed to implement or rather roll out the guidelines. So the suggestion is that they should be pushed back at least to June 2026, nothing before that. So on both these accounts, the government is very clear. I just wanted to highlight that, this after a long time, basically, the government has actually shared these kind of internal deliberations. They have put it out in the public domain. So it's noteworthy that it is an important issue from the government's perspective, and they want to ensure that the interest of the small borrowers and maybe to an extent even the companies is kind of protected. They're not adversely impacted.
Got that. Thank you very much for that important story. Let's now straight away take it to the first corporate on the show, Lemon Tree. The company reported a steady Q4, revenue surging 15.5%. Occupancy has improved on a year-on-year basis, and the total debt of the company has declined by 10% on a year-on-year basis. Patanjali Govind Keswani, Chairman and Managing Director of the company, is now with us on the show. Thank you very much, sir, for joining in. If you could give us an indication of how Q1 has been so far in terms of occupancy and the outlook that you have for the rest of the year in terms of ARR and occupancy. Do you think you can push it higher compared to last year?
Hi, Rima. I think certainly we will have higher occupancy in Q1 this year than last year, because last year in our hotel in Bombay, which is 15% of our inventory, was relatively new, and this year it has stabilized, which is the Aurika.
Right.
I think April, in and of itself, was a fabulous month. In May, two things occurred. One was this war, and one was this rise in cases of COVID. So that affected demand. But if I looked at it in the aggregate, I would say we would do about 15% better in revenue terms in this quarter vis-a-vis last year.
The entire year, what would your target be? Because last year was incredible. If you look at the entire year, you've done 20% revenue growth. Your margins have maintained that 50% mark as well. So first quarter notwithstanding, 15% for the remainder of this year. What's the guidance that you're giving?
It would be roughly mid-teens. So, guidance in the hotel business is like shooting in the dark.
True.
Because, sudden events can very significantly affect demand. So if I gave you a range, it would be, mid-teens plus minus 2%.
Truth to be told, in the VUCA world that we're in, guidance in any sector would perhaps be shooting in the dark, but, a little more for the hospitality space itself. In terms of capacity addition, that's where you have visibility. What's the kind of addition that you've lined up for in FY26 and FY27? And how much will occupancy scale up basis those additions?
Occupancy is a percentage. So
Yes.
I assume you're talking in terms of units or room nights.
No, I'm talking about room nights getting added, plus your occupancy in those room nights scaling up.
So Mangalam, it's very simple. We had given guidance 2 years ago that in 5 years we would hit 20,000 rooms.
Yes.
But I think we'll cross it this year, number one. Number two is, so we will give a fresh plan for 2030 because we are meeting all the set targets actually a year or two before we said we would. Number two is that we are already at, I think, 17,200 rooms. So we just need to add 2,800, which will certainly happen this year. Our occupancy is a sum of mature hotels and new hotels. It is the weighted average. So a new hotel naturally takes more time to scale up.
Yep.
So when you aggressively add new hotels, the occupancy of those hotels is always much less and brings the weighted average down.
Exactly.
That happened to us, for example, with Aurika and Bombay. So this year, I think our total occupancy was a touch under 72%. I'm pretty sure we'll do better than that this year. And my broad expectation is, based on how I see, change in consumer behavior, an inclination by a larger number of consumers for branded hotels, my broad guess is that Lemon Tree's occupancy will be 76 to 78%. 12 months forward. So that's how I'm looking at it. We will cross 20,000 rooms and we will be selling, something like 16,000 rooms on a steady basis at that level of control over supply. And
just for bookkeeping, typically for a new hotel, what's the break-even occupancy?
Well, if we design it and build it on an OPEX basis, it would be 21 to 23%. If you add debt, which is, I'm assuming that you have leveraged carefully and, you have loan to value is 50%, then typically you can pay your interest by about 35%, and you can pay your principal by 45%. So as long as we hit 50% occupancy, we basically pay for everything, and after that it's to the bottom line.
Since you're going to overshoot the capacity addition target of 20,000, what about on the debt front? You had guided to be debt-free by FY28. You lowered your debt by 10% last year. By FY26 end, what would the debt number stand at, and FY27 end?
I don't think it'll be, I think it'll drop by another 20%. But if we, as we said, most of our debt is in our joint venture, which we own 60% of, where the earnings growth has been quite significant. So best guess is we will definitely meet that timeline. But if we list Fleur, then we'll go debt-free, at that time. So debt-free 100% in 3 years. If we list Fleur before that, we'll be debt-free before that. And end of this year, we'll be, if we don't list Fleur, we'll be another 20% down.
Your ARR is about 7,042. In Q4, it went up by 7%. What's the outlook on the average room rent?
See, our room rents, we expect, see, when I say we'll grow 15% in revenue, my broad guess is that 1/3 of that will be by occupancy. So say 72 will become 75. And another 2/3 of that will be by rate increase, which is a good sign, by the way, because rate increase goes straight to your bottom line. Occupancy increase has some implied variable cost.
So, speaking about straight to your bottom line, the other thing that goes straight to your bottom line is management fees. You did about, 45 crores in the fourth quarter. What is the quarterly run rate likely to be? And by when do you reach that 350 crore annual management fee target?
We'll reach it in 2 years, for sure.
Okay.
But I can't give you an annual or a quarter. It's so much a function, Mangalam, of the hotel opening on time. So if we have a plan that, we'll open 10 hotels in this half year, and only 6 open and another 4 get pushed forward to the next half year, then it changes these numbers. I would look at run rate. So what I'm saying is our run rate by end of next year should be 25 crores a month.
Is supply becoming a problem? Because now everyone's looking at hospitality as a big, tailwind sector for the next 10 years or so, where the macros are favoring the overall sector. For so many players coming in, so many properties, is real estate supply and the cost of acquiring a new hotel increasing?
In fact, that's the good news, because if you put supply up at current costs, what it means is that it makes money at current costs. And what about the guys who have hotels on book value? So in that sense, an incumbent who has an existing hotel, has a much lower investment cost than somebody who's opened a hotel in that same location now. So typically the construction cost doubles every 7 years, 7, 8, 9 years, depending. So if I put up a hotel 10 years ago and I'm getting and somebody puts up a hotel today and gets a 12% return, then our hotel will get a 24% return because its book value or its cost to construction was, half of the earlier guy, the later guy. So I believe that supply is very necessary in India for 2 reasons. One is for consolidation rather than fragmentation. Number 2, for quality. Number 3, for competitiveness. And most importantly, I believe supply creates demand. So the more supply you create in the hotel sector, the more demand you create, basically.
Mr. Keswani, just mathematically, if 2/3 of your revenue comes in from an increase in the cost of a hotel room, what would that number stand at, the ARR, by the end of FY26? And are we in for, Mangala was just talking about how the industry itself has structural tailwinds. Do you think the ARR can keep compounding at that, growth rate?
I'm actually... Rima, I keep saying this, our current room rate is 20% less than what it was, 17 years ago. On an absolute rupee basis, forget inflation. So the good news for the hotel sectors, I expect room rates will continue accelerating, and they will accelerate to a point when it will be closer to the mean, which is the global mean. Number 2, as you know, pricing is a function of supply and demand. So no new supply will come up if the price is not right to give a return to that new supply. So why would I put up a hotel for, say, 250 crores to get a return of 10 crores? but that is what an old hotel may be generating today. So this is self-balancing. And I am pretty sure prices, I keep saying this, nobody believes me, but I'm pretty sure prices will be double in 3 years.
You had said that last year as well, and you've said that the year before that as well, and it's been the case. So 3 years ago, what the prices were versus what the prices are right now, it has almost doubled, if not doubled. Just a final question. You earlier also pointed out the possibility of the demerger of, assets and brands, because that's how globally the business is structured. What's the update for Lemon Tree on that? Have you considered anything in the very near future?
No, we will, as these are various routes to getting deaggregating or disaggregating the management asset-light business from the asset-heavy ownership business. It is very much one of the options we will consider, but our view is that we will list Fleur in some form or the other, and that is the asset-heavy side of our business. So sure, it is what you just mentioned, Mangalam, is one of those.
Thank you, Mr. Keswani, for joining in. Always a pleasure chatting with you about the company and the industry. We wish you all the best. Well, get into breaks, but we are very, very excited to unveil our brand new global business news channel, the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders, economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC TV18 Prime every day at 12 noon for the Global Reset and the Global Lens at 8:30 p.m.
Welcome back. A big move is what we're seeing in Manappuram Finance right now. It's up 4%. We spoke about Muthoot earlier and the possibility of some sort of relief coming in for gold loan borrowers under 2 lakh rupees. Manappuram Finance is a late mover to that party, but is moving quite ferociously as well. HDFC Life is the other one. This week, it hit a fresh life high after 3 years and continues its up move. This week's gain on that stock is close to around 5%. And we're also seeing some sell-off in Vodafone Idea, which continues. Currently down about 4% from the highs at the low point of trade itself. But L&T, that's the stock on our radar, and that's because of a case update that has come in, a relief for L&T in the Mumbai Metro case. Ashmit joins in with all the details here. Ashmit.
Well, this is a major relief that has come in for L&T. Bear in mind that L&T had challenged in the Supreme Court an issue of a tender that had been issued by the MMRDA. The tender had been issued for essentially 2 projects in Maharashtra. One was an elevated road from Fountain Hotel Junction at Thane, Godbandar Road to Bhayandar. The other one was an underground road from Gaimukh to Fountain Hotel Junction. Now, what's important to understand is that this tender aggregates to about 14,000 crore rupees. L&T at the technical stage itself had been disqualified, and that is what they had contested in courts. Now, what's important is that while this was contested, the Supreme Court had made some very stern observations, had essentially questioned as to how this entire tender process had gone about, had questioned L&T's disqualification, had at one point also remarking that L&T, which is responsible for constructing Delhi's Central Vista project, how could such an entity, how could such a party have been disqualified? There were very pointed remarks that had fallen from the apex court in view of L&T's contention, L&T's disqualification, and that is what we understand has now led to a decision by the MMRDA where they've said that on account of all these concerns they're scrapping this entire 14,000 crore rupee tender altogether. So this entire concern that had been raised by L&T yielding returns in the form of scrapping of this contract. Now, as far as the road ahead is concerned, MMRDA says that the future course of action is to be decided by the Maharashtra government. So for now, major relief coming in. That big contract, that 14,000 crore rupee contract that L&T was on the cusp of losing now stands scrapped. The future course of action to be decided by the Maharashtra government.
Take that point entirely, Ashmit, and take note of the pointed questions as well as someone that's designed the Central Vista project. How can that be, taken out on technical grounds for a metro case itself? Speaking about construction, the next company on our show is NCC. They reported a decent fourth quarter where order inflows have gone up by 20.5%. Profit after tax has also increased by 11%. But on an overall year basis, the execution has been slightly on the slower side. The revenues for FY25 rather have been around 6.5% higher itself. The stock slightly under pressure right now. We have Neeraj Sharma who's joining in. Neeraj, thank you for joining in. Just on FY26 guidance, the order inflow was strong in the fourth quarter. Execution of just 10% growth, that comes on a favorable base. I mean, how can you get better on the revenue front and even the margins? By when do they get to double digit? I think you're on mute. You'll have to unmute yourself.
No, I'm.
Yeah, go ahead. We can hear you now.
Yeah. So the point that I was trying to make was, firstly, let me give you a little overbrief of the last year, that is FY25. We had shared 3 set of numbers with the street. The first number was, the order inflow guidance. We have been able to handsomely achieve the guidance that we had shared with the street. You have yourself, just quoted the numbers. The revised guidance that we had shared for the revenue was, revenue growth of about 5% that we have been able to deliver. On the margin guidance, also the guidance that we had shared on the EBITDA, we have hit the number. Now talking about FY26, this last year, that is FY25, was, an unusual year in more ways than one. Firstly, this was not a year of 12 months, typically speaking. The point that I'm trying to make is as follows. We have the bulk of the projects that we have been able to bag has just come in the Q4. If you talk about the first 9 months of the FY25, all that we had bagged was, about 13,000 odd projects. The 60% of the total award that we have bagged in FY25, which is 32,888 crore, has really come in the last quarter. That too, in the last month of the FY25, that is March. It takes time, for these projects, to mobilize, to get all the ROWs in place, for the construction to start. It takes time. There is a time. Even when we start the construction, there would be, recognition criteria, milestone guidance, for recognition of the revenue as well as profits. So and the monsoons are right around the corner. So that is the reason, we have decided to share a guidance on the basis of the assessment, the best assessment that is available to us. And that is the reason we are talking about revenue growth of 10%, which we believe is a good guidance. And I also take this opportunity to share with you the fact that if you really see the growth of the company last 3 years, we have been able to deliver a CAGR upwards, close to 25-26%. So that's the base itself is a, little bit on the higher side.
Right. Okay. And on the margins, 8.64% is what you've done. 9 to 9.25 is what you've guided for. Double digit happens when?
That's right. Yeah. I mean, hopefully in the next year, that is FY27. But we have to see. We have to also look, at the net profit. In the last FY25, we have been able to deliver, a PAT growth of 20%, which is a good profit number. So let us not only look at the EBITDA margin, let us also look at the net profit number.
Okay. Got that. So revenue guidance 10%, EBITDA margins 9 to 9.25%. Order intake, I think, is 22 to 25,000 crore rupees, right? That's the guidance.
That's right.
Okay. How much of that is already L1 of this order inflow guidance?
The L1 number would be, anywhere between 7 to 8,000 crore. And if we really take into account the order that we have bagged in the month of April, which is 1,663 crores. So we have already, let us say, achieved about 8% of the lower band, that we have shared with the street.
Okay. And this, Amravati, the capital city project of Andhra Pradesh, lots of hopes are pinned on that. in Q4, did you win any orders linked to Amravati? And of your order inflow guidance of 22 to 25,000, how much of that is linked to the Amravati development?
See, most of the, we have been able to bag good number of projects for this new capital city, that is Amravati. This number would be about, 9 to 10,000 crore.
Is what you've already bagged?
That's right. In the last quarter.
And how much of the order inflow guidance for FY26 would be from Amravati?
We have to wait and watch. It would really depend on what kind of projects really do come up for bidding. Then, we will assess those projects and then take a decision whether to bid or not. But happy to report that we have been able to, corner a sizable chunk of the awards already, which is a little less than 10,000 crore.
Could you give us a sense on what your bid pipeline for the year is? You are 7 to 8,000 crore L1. How many other orders are you bidding for? What's that pipeline like, and what your hit ratio typically is?
The prospective pipeline would be, more than 2.5 lakh crore for the FY26.
And your hit ratio is, I suppose, 10% because you're guiding for 25,000 crore worth inflows.
Approximately, it keeps changing. It would really depend on the competitive intensity in a particular vertical, what kind of projects are coming up for bidding, the size of the project.
On execution, I wanted to know if there are some working capital challenges, because yesterday we did have a management join us saying that, the Jal Jeevan Mission receivables haven't been haven't been given by the government, released by the government so far. Do you have any exposure to Jal Jeevan Mission or any other authorities from the government where execution has been a little challenging because of the late release of payments?
Yeah, we do have some exposure,
How much would that
from
be?
this mission called Jal Jeevan Mission. We have been able to get some payment, in the month of April, and we are hopeful. I think that problem is across, across board for the whole, scheme as such. But we are hopeful. We are hopeful of, getting the balance payment. But let me take this opportunity also to share with you, there have been challenges. There have been challenges related to payment for the FY25, not only for, this scheme, few other schemes as well.
So how much would your amount be receivable right now, which is overdue beyond the normal course of payment?
That you're talking about the data number we have already shared, it would be close to.
No, that's the total data number, but stuff which is overdue. Like you said, there have been some challenges in a lot of them. So say, for instance, your average data number is 30, 40, 45 days, or average terms are that. What proportion of that number is overdue right now?
That is difficult to quantify, Mangalam. See, we do, about 150, 160 odd projects. It would be difficult to quantify.
Okay. What's the expected revenue from smart meter projects in FY26 and the kind of order booking? You've made an investment of 280 crore rupees, I believe, in smart metering, and you're hoping to get in a partner.
That's right.
And
Firstly,
the revenue go ahead. Revenue forecast.
Yeah. Firstly, we have not made. We plan to make in the FY25. We have made an investment, about in the range of 70 crore for the smart meter projects. And we have planned to make, this kind of investment anywhere between 250 to 300 crore for the FY26, depending on the progress that we are able to make. This would be, and we are also, scouting for a partner, but this would really depend on the progress that we are able to achieve on these smart meter projects. I also take this opportunity to share with you that we have 3 smart meter projects. The total value of the project would be a little more than 8,000 crore.
All right. Okay, take that point. Thank you so much for joining in, Nirad, and giving us your views for FY26 and putting on board the challenges that the industry is facing as well. But wish you good luck for the execution that you have for this year. 10% revenue growth guidance with 9 to 9.25% EBITDA with 22 to 25,000 crore worth order wins this year. That's NCC. Take a short break, come back. Ajit Mishra of Religare Broking joins in with some trading strategies. Stay with us. Welcome back. The market down about 100 points for the Nifty. Just keeping an eye out on the F&O space. And this one, apart from how the market is behaving right now, the important part is we're seeing traction in names like BSE, Angel One and Nuvama Wealth. This at the start of June series, also because yesterday evening we had a circular coming in from SEBI on F&O. Two things really stand out from that. One, they've said that open interest will now be measured basis delta and not notional open interest. Remember, delta of options is a lot lower than futures. So basis that, the open interest for total F&O contracts will be measured. And the second part is that market-wide position limit will either be 15% of free float market cap or 65 times average cash volume, whichever is lower. What this basically means is that delta-based OI and delivery-based market-wide position limit will reduce potential manipulation. You've heard of, way out of the money options being used to put stocks into F&O ban, etc. These norms, which come into effect from October 1, will, reduce these potential manipulations. What is also good is that there has been no intraday limit as earlier proposed in the consultation paper. So the actual norms aren't as drastic as were issued earlier in Jan-Feb itself. And end-of-day gross limit proposed at 1,500 crores in the consultation paper is actually now set much higher at 10,000 crore. So a lot better for all the participants, and that explains why these stocks, which I earlier mentioned, are doing well. For the Nifty itself, start of June series has been on a bit of a back foot, but we'll track today's low and potential recovery from here on itself. 24,800 call and 24,800 put, both equally active, telling you that those who are writing the 24,800 straddle are playing for a broader range of 24,600 at the lower level to 25,000 at the upper level for the index for the next week. Birla Soft seen a big spike in open interest, may enter F&O ban, so we'll keep an eye out on that. Take a short break now. Ajit Mishra joins in.
Welcome back. Let's now talk market technicals. Ajit Mishra from Religare Broking is now with us. Ajit, thank you very much for joining in. Muted day, what would the stock calls be?
Yeah, good afternoon. So since we are seeing consolidation continuing for almost 2 weeks now, it's prudent that until we see a decisive break in the index to maintain position on the both side. So first stock that we like on the buy side is SBI Card. So if you'll see almost a 1 month long consolidation seems like to be over in a day or two. With a positive breakout, and 957 is what we are eyeing in SBI Card with stop at 900. On the short side, Asian Paints, after this failed attempt of recovery, we are seeing again a shorting pivot formation on the daily chart, which may push this stock towards 2190 in the near future. So here one can go short with 2310 as a stop loss.
All right, take that point, Ajit. Thank you so much for joining in. Those are a couple of stocks that he's spoken about. One of the stocks which is doing well today is Senco Gold. So what we'll do is take a short break, come back. Suvankar Sen, who's the MD and CEO at Senco Gold, joins in to discuss their fourth quarter performance and more importantly, the outlook for FY26. Stay with us. Welcome back. You're watching us here on Halftime Report. Senco Gold is the stock on our radar. Reported a very good set of numbers in the fourth quarter, especially after the previous 3 quarters where there was a sharp margin contraction. And as guided by the management earlier itself that they would see margin recovery in the fourth quarter, that's exactly what has happened. The stock up 1% right now because over the last 3 months or so, it has seen a big rally, though still 50% off its 52-week high. We have Suvankar Sen joining in. Suvankar, let's start with your outlook for FY26 because the first quarter you had given an outlook of 18% revenue growth because of the Poila Boishakh as well as Akshay Tritiya sales that you saw already. Do you stand by 18%? Do you think you can better that? And for the full year, what's your margin and revenue growth outlook?
So if you look at the previous year's full performance, in terms of revenue, we've grown by 19.7%. And if you look at the way the numbers have been looking in the month of April and May, we are growing in the range of 18 to 19%. So while our efforts and endeavor will be to take it closer to 20%, but I will stand by the growth, revenue growth of 18 to 20%. And until now, I think that we are clocking those numbers.
And for margins, what are you talking about? Because you had said 8 to 9% earlier. You recovered that in the fourth quarter. Do you think this run rate now sustains for the next few quarters?
So see, we have to understand that why were the margins looking low in the previous financial year, and time and again, we said that the impact of customs duty in the month of
Yeah.
August was the one which was impacting the overall margins. And we were confident that in the Q4, where we could see that, the diamond selling trend had picked up. The duty impact was done and away with, so that wouldn't be there in Q4. So that is how we saw that the recovery happening in Q4. And I think that we can continuously see that interest in diamond jewelry, especially with the gold prices being towards the all-time high. So while the confidence and the trust on gold as a commodity continues to remain in the mind of the consumers, but they are also looking for lower cost, options, which is in 14 and 18 karat jewelry with diamonds studded in it. So the diamond sales are continuously in an upward trend right now. So yes, in terms of margin, if I look at it, the EBITDA levels, adjusted EBITDA of the previous financial year was around 6.5, 6.8%. So that, yeah, my 6.8 to 7.2 is the EBITDA levels that we will be looking at for the whole financial year.
Okay. So diamond growth was very strong, 39% in Q4, and I believe it's about 11% of your overall revenues. Now with consumers perhaps moving towards or being a little more aggressive on diamonds, what could the revenue contribution of diamonds go up to? What would the growth be? Can it sustain the Q4 run rate, for instance?
On a sustainable basis with the various seasons that we see, we are expecting a growth of close to 20 to 25%, because the diamond growth in such a situation and a scenario is usually higher than a gold growth. It is just that the gold prices have been on an all-time high. It has moved up so much. That's why we are seeing a value growth of almost 20% and a diamond growth of, say, 35% in the current ongoing scenario. So I think that, yes, a 25 to 30% is going to be our effort. And if the gold prices continue to remain on such high levels, consumers will be looking at buying more of diamond jewelry. However, the catch point here is that Q1 is one of the festive season. Q2 is one of those seasons when we usually don't see much of buying happening. We all have to look and pray for a good monsoon so that the upcoming festive season of Q3, the wedding seasons, and the Q4, that should be strong. So Q2, we will not see as much as that kind of number. But again, Q3 and Q4, we will see a good pickup in terms of diamond and in terms of overall jewelry industry also.
Yeah. Just to confirm, 6.8 to 7.2% is the margin guidance that you've given for this year.
EBITDA margin, yes.
Yes. Okay. On gold prices and diamonds and how consumer behavior is likely to be is what my question was on right now. Because yes, gold prices are making record highs consistently, so consumers are reducing the volume purchase, and because the value purchase is increasing, and secondly, they're looking at alternatives. But diamond, while you're buying jewelry for adornment, you're also buying it as an investment value. Diamond hasn't proven to be a good investment over the last many years, and with the lab-grown diamonds coming in, etc. as well, that the attractiveness of diamonds as an investment proposition has come down even further. So do you think that consumers will now buy plain gold things like coins, etc. going forward as against jewelry for adornment, which may not be as high value? I mean, just wanting to understand what consumer behavior at high gold prices is, because we've also seen your gold exchange, old gold exchange, come up to 39%.
Yes, old gold exchange has come up to 39%. And what we are seeing is almost 60% of that is the non-Senco gold that is coming in, which means that, like what we have been seeing in the last 3 years, the shift from unorganized to organized is happening at these high gold price level also. And as far as the investment outlook of a consumer towards gold versus diamonds is, see, we need to understand two things. One is that it is only solitaires which has always been looked up as a investment for diamonds. Small size diamond, which is almost 90% of the business that we do, has been looked at more as an adornment, as beauty, as a symbol of romance for the daily wear or for weddings and all of that. It is only in the bigger size that the diamonds have looked as investment. So what we are seeing is that the consumers who were investing in diamonds have also started understanding that, no, they need to invest in gold bars and coins when it comes to investment. But when it comes to adornment, what people are seeing is that at such high gold prices, the lightweight everyday wear jewelry, which is the I think we are seeing the average ticket size that is, for us. Let me tell you one more number. The average ticket size, which was 63,000 rupees in the previous financial year, has gone up to around, it's gone up by 15% to 72,000 rupees. So irrespective of the fact that, we are talking of gold prices moving up, there has been an increase that the consumers are having to shell out a higher value in terms of what they want to invest in jewelry. But that is not equal to the rise in gold price, which means that there is a 4-5% decrease in volumes, which means that now consumer is saying that fine, and in this range of 60 to 70,000 rupees, what is it that I can wear on a daily basis? If gold, it is looking too light, but if it's diamond, it's looking modern, trendy, and stylish. So that is where we are seeing a convert. So our stud ratio has been 10.9. And what we have been saying is that we want to take it closer towards 15%. And I think that is very much a possibility in such high gold price scenario. So I hope that what I try to explain is solitaires. Yeah. And one more information is solitaire prices are now gradually in an upward trend. This coming 2-3 months is
right. So we take that point entirely. Suvankar, finally, before we let you go, you've given us a great primer on how to look at gold and diamond as investment or adornment and all of that and stuff. What about the primer on investment in your own stock? Because promoters have increased their stake over the last couple of months, but this after having diluted their stake via QIP as well. QIP shareholders on an adjusted basis has still sitting on a loss. Their buy price was 570 odd rupees. Despite the up move that we've seen from the lows on the stock price, they're still, sitting on losses. How do you assuage their concerns right now?
No,
and are promoters buying more at these levels?
So I think that, the QIP investors need not worry. Q3 numbers were looking depressed because of the duty impact in terms of what we saw, that the prices coming down and the impact it had on the inventory and the profitability. But fundamentally, as I keep saying, that nothing changes. The consumer interest towards the product and category and the brand continues to remain strong. We actually saw a 6% increase in terms of the invoices. We have added 2.5 lakh new consumers into the brand. So I think in the long run, nothing really changes. And it is only, the geopolitical scenario, the market sentiments, the uncertainty that is just creating a little bit of irk in the investor's mind. But in the long run, I think Q2, then Q3 and Q4, especially with the festive season, I am very much positive towards the growth of the company. And if you ask me that at these levels, will I be interested in buying? Maybe yes. Whether I am buying or not is not yet something that I can talk about right now. But I think that we can be confident about the future of the company.
Mr. Suvankar, thank you very much for enlightening us about what's happening in the industry and the company. Thank you for that. Get into a break. On the other side, Manisha Gupta joins in with Sumit Gupta of Vasida Global Commodities. Stay tuned.
Welcome back, and joining us on the show now is Sumit Gupta. He's CEO of Vasida Global Commodities. Sumit, hi, thank you so much for joining in. Your first reaction on the MSPs, really, because there's just so much conversation on this. I do understand that MSP is a regular thing, comes twice in a year, but the reaction this time comes in on the back of the fact that we've seen the highest of MSP for ragi and the lowest perhaps for paddy.
Very good noon, ma'am, and thank you for having me on the show. And you have raised a very important point, because let me ask the question: when you are saying MSP, do you mean minimum support price, or you mean maximum price possible for the farmer at the moment? Because what has happened in a way by increasing MSPs which are not in line with market, and specifically, as you have mentioned, maybe highest for ragi and lowest for rice, government is signaling to the farmer that you should plant less rice. But it is not going to translate completely into cropping pattern as such by only through MSP till the time buying mechanism for the other crops are in place. For example, government has given a lot of incentive on planting of pulses. And if you can see today, pigeon pea prices in open market is trading around 6,500 levels. as against if you see the MSP of 7,500, and next year promised MSP of 8,000. So we have a lot of distance to move on converting policy into action for farmers on ground.
Sumit, there has been various conversation and data as well, which shows that not even 20, and in some cases even 15% farmers are able to get that MSP. I'm not talking about wheat and paddy here, but for the rest of the commodities.
Absolutely. If you look at the pigeon peas, total procurement that government is able to achieve is around 600,000 tons on a crop of approximately 4 million tons, which is maybe 1/7, around 15% of total production is being procured by the government. And though market surplus in these crops are much higher than wheat and rice, which farmer keeps for their own consumption, but what is more important point is it takes away confidence in the long-term policy making from the farmer point of view. And the farmers who produce or the crops which are not being procured by the government are the most marginal farmers who are based in Maharashtra, Karnataka, Andhra, and parts of Rajasthan and MP. So I think there needs to be a better conversion of policy into action, and giving such a high MSP without that having a good track record is not a good thing.
So, Sumit, would you say that a fine line perhaps needs to be drawn? Because on one side, the government is increasing MSP for farmers, and on the other side, keeping many of these commodity prices in check for the consumers.
It's a very good question, actually. How do we, because when you talk about US and talk about Fed, they say 2% inflation is our target. In case of RBI, we say 4% inflation is our target. But if we increase MSP by 4%, 3 to 4%, or 5% in certain commodities, how can you have a 4% inflation target year on year when 46% of the inflation basket is made up of food items? Because if you increase grain prices by 4%, the milk prices will go up at a higher quantum, or animal product prices will go up at a higher percentage than that. So the point that or the question is addressing is very important, that we should look at inflation which negates the impact of MSP. And we cannot have a reasonable target of 4% inflation by increasing MSP 4% year on year. That means one signal that you are giving to market that we don't respect MSP. And commodities will trade at a price lower than MSP for farmer.
The other concern I want to put forth and get your response on is about maize, because we've seen a very strong MSP increase, 2,400 rupees a quintal. Do you also believe, are you also on a school of thought where you think that cotton, soybean, and perhaps pulses area could go down in favor of maize?
So it's again a very important question, because if you look at the competing area in the farmer margin analysis, the competing area between maize and cotton is Gujarat, Rajasthan, and Maharashtra. Among soybean and maize is largely MP, south of MP and Maharashtra. And for sure, the kind of MSP increase that we have seen in both in case of soybean and maize will put farmer at a spot that what crop he should go into. But let me put it this way, government does not have infrastructure to buy maize at majority of the places. Last year, government bought almost 2 million tons of soybeans, but still, if you see soybean prices throughout the year traded much lower than MSP levels, which is a psychological inhibit for the farmer to go for oilseed planting next season. And as in case of maize, as you have rightly mentioned, farmer may look towards planting more maize. Why? Because yield in maize is quite good. And with the ethanol sector coming in, farmer has been able to get good realization. And if monsoon stays good, which though with after a good start, next 10, 15 days looks a little tepid, then we are in for big maize crop in the coming season.
Fair that point. Take your sense on all of those commodities there, and the fact that, of course, the government will have to walk that very fine line about increasing MSP prices, but also ensuring fine prices for the consumers there. Thank you, Sumit, for joining in. And with that, it's a wrap on Halftime Report. Business Lunch will take all the action ahead.